Okay, let's talk about investing in stocks of other companies. Sometimes textbooks will call them equities. It means the same thing. There's three different ways to account for our investment in stocks of other companies. And the three different ways depend on our intentions. And we're going to judge our intentions by the percentage of the other company that we own. So if we own less than 20%, we're going to assume that our intention is to make money, either from capital gains, buy low, sell high, or from collecting cash dividends. If we own between 20 and 50% of another company, we assume that we're not only looking to make money, but we're also looking to exercise significant influence over that other company. And if we own more than 50%, we assume that we're not only looking to make money, but we're also looking to control that other company. So depending on what percentage of the other company we own, we will account for this investment in their stocks in a different way. Okay, so there's three different ways to account for stock ownership depending on what our percentage is. And to make it even more complicated, there's three different ways to account for our stock investment if we own between 0 and 20% of the company. The first is the cost method. If we don't have any idea what that stock is worth after we buy it, maybe it's a small company that isn't publicly traded, what we'll do is put it on our books at our cost and leave it there. For example, we buy stock in a small company, we pay $40,000 for it, it's not traded on any exchange, so we've got no way to adjust it to its fair value. So we leave it on our books at our cost, and if we sell it later for $39,000, we'll take a $1,000 loss. The next possibility, and probably the one that gets used the most, if we own between 0 and 20% of the other company, is the fair value method. So the first thing we have to do is designate the stock as either a trading stock or an available for sale stock. So whether we're investing in bonds or stocks of other companies, there's a category called trading. That means we're calling ourselves smart. We're saying we're going to actively trade these things. We're going to make money buying and selling these things. Another category is available for sale. That says, hey, we're not actively trading these things. We're not watching the market every single day. We had some extra cash laying around and we got tired of earning 0.5% in our bank account, so we invested in these stocks or bonds. There's also a category called held to maturity for debt securities. Obviously, stocks don't mature, so there's no such category for equity investments. Okay, so we're going to designate these stocks as either trading securities or available for sale securities. Then we're going to, quote, mark them to market, close quotes. In other words, we're going to adjust them on our balance sheet to reflect their fair value. Maybe we'll do it every day, maybe we'll do it every month, maybe every quarter. It depends on the size of our company and the size of our portfolio of stocks. And the only tricky nuance is, obviously, if we debit some fair value adjustment account to increase the value of a share of stock on the balance sheet, we've got to have a credit somewhere. And if it's a security we've designated as a trading security, that credit will be to an other revenue and gain account that's part of net income. If we designated that security an available for sale security, that credit will not be part of net income. It'll be part of something called other comprehensive income, which will close into an account called accumulated other comprehensive income on the equity side of the balance sheet. And what's going to happen is our book is going to shortcut that whole income statement thing and just talk about crediting an account called unrealized gains or losses equity. So the odd thing is, if it's a trading security and we haven't even sold it, if it's an unrealized holding gain or loss, it's still going to be part of net income. And the third method we might use if we own between 0 and 20% of this other company is something called the fair value option. And that says anytime we buy any kind of financial instrument, a note receivable, a bond, a common stock, a preferred stock, we can opt at the first instance to say this is going to be a fair value security. We're going to mark it up or down, and all those changes are going to be part of net income. And whether we're using the cost method, the fair value method, or the fair value option to account for these stock investments, we'll record dividends the same way. When a company pays us dividends, we'll debit cash and credit dividend revenue. And that dividend revenue will be an other revenue and gain account on our income statement. Okay, so if we own 0 to 20% of the other company, then we're going to use either the cost method, the fair value method, or the fair value option. If we own between 20 and 50% of that company, it's assumed we have significant influence. So when we're doing the 0 to 20%, when we got dividends, we debited cash and credited dividend revenue. Well, the thinking is, if we own this much of the company, we can pretty much dictate when we get paid. And so that measure of revenue is not an effective one. So instead, we're going to say their income is our income. So if we own, say, 25% of another company, we're going to use the equity method. What's going to happen is if they make $1 million in a year, we're going to take $250,000 of that, put it on our balance sheet as an increase to that equity method investment, and book $250,000 worth of equity income. So even though we didn't make that $250,000, even though we didn't get a check for that $250,000, we'll increase that investment on our books by $250,000, and we'll book $250,000 of something called equity income. Unfortunately, our book just uses the term stock investments for the balance sheet and revenue from stock investments. I don't think those terms are very descriptive. I prefer the terms like Coca-Cola uses, equity method investments and equity income. And then when they pay us dividends, we'll pretend like they're cashing us out of our investment. So we'll debit cash and decrease that balance sheet account called equity method investments to reflect the fact that we've gotten some of our money back from that investment. And finally, if we own over 50% of the other entity, we're going to have control over them. And we can use whatever method we want internally to track their performance. We'll probably use the equity method. And then when we go to present our financials to the outside world, we'll consolidate them. We'll combine them. So we'll take their income statement and our income statement and combine them. We'll take their balance sheet and our balance sheet and combine them. And if we don't own 100% of them, the part that we don't own is going to be called the non-controlling interest. So we'll break that out on the income statement and we'll break that out on the balance sheet, the part that we don't own. So how we account for our stock investments depends on whether we own 0 to 20%, in which case we'll use either the cost method, the fair value method, or the fair value option, or whether we own 20 to 50%, in which case we'll use the equity method or the fair value option if we choose. Or if we're going to own between 50 and 100%, we're going to consolidate. We're going to combine our financial statements with that investee. All right, hope that helps.